We've been researching and investing in future trends since 2011. We believe that by identifying long-term trends and then the businesses that are best placed to benefit from that, this can be a very lucrative strategy for our clients. We've been investing in a number of these single stock names since that time. In 2013, we launched a dedicated strategy for our clients, and in 2016, we launched in a UCITS format the Heptagon Future Trends Equity Fund. The strategy of the fund is to deliver long-term returns in excess of the market. We aim to do this by investing in a diversified range of pan-thematic businesses. In many ways, identifying a theme is relatively easy. I think we look around and we can see a lot of the secular trends in terms of aging population, industrialization, changing energy usage, growing data consumption. The much greater challenge we find is identifying not just the businesses that benefit from it, but also those businesses that have the best ability to create value for shareholders. We therefore have a very rigorous and thought-through investment process. We like to invest in businesses that have dominant market share, offer pure play exposure to a theme, and in order to achieve both of those factors, these businesses really have to be outspending their peers in terms of research and development. The other things that we consider very important are obviously valuation and the quality of the management team with whom we interact. I think I could probably distill it down to two. Number one would be don't fall in love with the businesses in which you invest. For us, valuation is absolutely crucial. And number two, don't invest in something you don't understand. It's very easy, particularly when looking at future trends, to get very caught up in hype and so on. For us, it's very much about businesses with clear, coherent and differentiated business models. I think probably the first example I'd cite would be a UK-listed business called Sophos. Sophos is a leading play on cybersecurity. I think we all appreciate the data deluge, in other words, the growth in production and consumption of data. That data, to our mind, has zero value unless it can be stored efficiently, analyzed efficiently, and most crucially, secured efficiently. That's where Sophos comes in. To our mind, it's a fairly unique business. It serves only mid-market companies. It offers an endpoint and network solution. Everything has been cloud-based from day one, and the company is very forward-thinking in terms of where it's investing, particularly in next-generation solutions. To give you a totally different example of another future trend and business that we're invested in, I would highlight Vestas to you, Danish wind turbine manufacturer. It's very clear about the direction of travel in terms of energy consumption. Many reports suggest that by 2050, 50% of the world's energy will come from renewable sources, and we believe that most of this will actually come from wind. Vestas, as the world's largest manufacturer and servicer of turbines, we think is particularly well positioned. They have a very low cost and efficient business model. Their margins are 5 percentage points ahead of the peers. They run a very strong balance sheet and high cash generation. I think we've got three very simple messages in terms of investing in equities at present, and they're as follows. Number one is active over passive. Number two is value over growth or momentum. And number three is emerging markets over developed markets. This is very much a stock picker's environment, we believe. I think equities probably remain a more attractive asset class relative to other mainstream conventional asset classes. But I think the key message we have at present is really not to be chasing the bull market. In other words, we've seen 9 years of very strong returns for equities, and we'd rather be a little bit too early than too late. A lot of it ultimately comes down to valuation, and I think we all have to recognize that there is a changing investment environment. We've really moved from this era of quantitative easing now towards one where central banks are likely to be moving much more towards a tightening phase. Against that background, the assets that did very well in an easing environment should do less well now, and vice versa. I think MIFID is very much a learning experience for everyone in the investment industry. And I think what is going to happen is that investors will need to do more work on their own. They'll have to rely, or they will rely less on the conventional sources, and particularly mainstream brokerages, than they did in the past. Against that background, I think it really behoves corporates, number one, to interact and reach out with investors more intelligently, and number two, to think about working with as many different stakeholders in the value chain as possible.